Welcome back to another YouTube video. In today's video, we'll be going through the ICT silver bullet model. I'll be providing you guys with a full breakdown of this model from A to Z, hopefully guiding you to consistent profitability in the markets. But before we get into the video, I've got a huge announcement to tell you guys about. The Top Trading Floor Discord server is now live for the public and is ready to run, as well as the VIP Top Trading Floor. Now, what comes with the standard Top Trading Floor Discord server is as follows. We offer Top Trading Floor chat where you and like-minded people in the chat could talk about trading and discuss trade ideas such and such. You guys got trading questions as well in there where you guys could also ask each other trading questions and help each other out to progress as a better trader. And that's what it's all about in this community. And I'll be sure to be in those chats as well, guiding you guys and helping you guys to achieve consistent profits in the markets as well. Again, same thing here, trade ideas. We got psychology tips. I've got a full page of that psychology tips in there where you guys could read through and help your psychology, because again, we all know that psychology is the most crucial part of trading. Then we got trade recaps. This is where I only have the ability to send messages. I send my trade recaps on a daily basis. I announce my daily buys as well, and I've also announced the economic news events and tell you guys whether it's a good trading day to trade or not a good trading day to trade, and so on and so forth. Then also I got my full blueprint of my strategy in the Discord server. So if you want my full blueprint of my trading strategy, it's right in there as well. That's for free. You could access it right there. So yeah, we got heaps of things to provide and offer you guys in order to become better and better in the markets. Now, what comes with the VIP Top Trading Floor Discord server are the live trade signals, where you guys could take literally the exact same trades I take every single day in the markets. I type them in and you guys just execute as soon as I execute my trade. Now, I also do provide trade recaps, but this one is different to the free one, where I go much more in depth and talk to you guys about what you need to do here and there, and talk about the really small pieces behind every single trade that I take. As well as that, I do provide obviously the VIP traders chat and ask Carlos questions. Now, this section right here, you could ask me as many questions as you want, obviously trading related, and I'll be sure to get back to you, me personally, in the next 24 hours or less. It's pretty much a one-on-one mentorship here, but we're keeping it as a Discord server for now. All right, so let's get back right into the video. Now, the silver bullet definition. The ICT silver bullet is an intraday reversal setup. It's a high probability opportunity that typically appears once a day. It forms within a specific 30-minute time window, such as the 9:45 to 10:15 macro or the 10:45 to 11:15 macro. During this period, we anticipate price to move either higher or lower, depending on the draw of liquidity on the day. Our entries, stop losses, and take profits are determined using ICT concept confluences to maximize precision and consistency in the market. Okay. Now, the first thing I want to talk to you guys about is daily bias. Daily bias is essentially looking at the higher time frames, such as the daily, the 4-hour, and 1-hour time frames, to determine whether a price is bullish or bearish. By determining the daily bias, it gives a clearer understanding on where price wants to go for us to take a high probability setup. It is very easy to determine our daily bias on a day-to-day basis simply by using fair value gaps. Now, we want to look at the fair value gaps on the, first of all, the daily. And if we don't find any daily fair value gaps, then we move down to the 4-hour. And then if we don't find any 4-hour fair value gaps, then we move on to the hourly time frame. These fair value gaps on the higher time frame show us a strong indication on where price is willing to go next. So if we look to the left-hand side here, we have a daily chart and a fair value gap right here. Now, this is a bullish example right here. If a bullish fair value gap forms on a high time frame and price retraces into it before pushing higher, such as we see right here, price retraces into it, we can anticipate continued upward movement towards the next clear draw in liquidity. In this case, the buy side liquidity. Vice versa, a bearish example, if we have a bearish fair value gap, as we see right here, price retraces into it, it is anticipated that price is willingly gonna go to the downside. And as you can see right here, it delivers ever so perfectly. Now, moving to draws on liquidity. What is a draw on liquidity? A draw on liquidity is pretty much where price is magnet to. Where is it willing to go to? Okay. Number one is we have session liquidity, such as London highs or lows or Asia highs or lows. Number two is previous day high or previous day low, relative equal highs or lows. Now, this is a very strong draw on liquidity, which acts as a powerful magnet for price and is one of the strongest forms of liquidity. Price usually always tends to take out these equal levels quickly. Now, we also have internal buy side and sell side liquidity, such as swing highs or swing lows, unfilled fair value gaps that are inside a premium or a discount, and equilibrium, 50% of the price range as well, is a draw on liquidity. Another draw on liquidity we have is a new week opening gap, which is a gap in price that forms from Friday New York close and Monday Asia open. This is unfinished business. It's considered to be unfinished business because it's a gap without any candlesticks in between, and price is likely to fill that gap before continuing higher or lower depending on the state of the market. Now, talking about a very, very important topic here is risk management. A very important topic other than risk management is psychology, and we'll get into that later into the next slide. But first, we'll talk about risk management. The maximum amount of risk on NQ you would want to be risking every single trade is 30 handles. Now, if you take a trade and win, you're done for the day. That's it. You're off the charts. You're not trying to make more money, or you're not trying to double your money. You're not trying to do any of that. You'll leave, you get off the charts, and you go enjoy your day. Now, if you take a trade and lose, again, you're done for the day. You risk your 30 handles, you're out of the market, losses are part of the game. You got to remember that. If you take a trade and break even, let's say you take a trade in the first AM macro and it hits your break even point, then it's okay. You could have one more trade in the second AM macro if you even get the opportunity to trade. Now, looking at a prop firm example on a 50K account, if you're risking 25 handles, then you're going to be placing a position size of 10 micros. And if you're risking 26 to 28 handles, you're going to be placing a position size of 9 micros. Risking 29 to 30 handles, you want to be risking 8 micros. And now that is taking into account the $2,000 max loss limit, mostly on all prop firms. Now that is the evaluation stage. You're risking approximately $500 per trade to get to that $3,000 profit target, because again, that's what most prop firms use as their profit target. Now on a funded stage, on the right hand side here, we have 50K account example, same example. You're risking 25 to 27 handles on a trade. You want to be only having a position size of 5 micros. And if you're going to be risking 28 to 30 handles, you want to have a position size of only 4 micros. Taking account again, that $2,000 max loss limit. On a funded stage, you're risking approximately $250 per trade to make 500. A 1 to 2 risk to reward ideally. Now let's talk about the most important part of trading that gets a lot of traders in trouble, which is psychology. Don't fear being wrong in the markets. You're not supposed to be right every single time. If you do analysis and your bias, let's say, is bullish, and you get a perfect entry setup that follows your strategy from A to Z, and you put the right amount of risk on and you enter the trade and price goes to your stop loss, don't be upset about it. Price is not always going to go where you want it to go. So it's absolutely fine. The most important part is to take your trade entry and execute on every single trade setup that you see that follows your criteria from A to Z. That's the most important part. Now, the second thing that we have here is don't have FOMO, fear of missing out. If you miss your entry, don't chase price. Heaps of opportunities will appear in the future. A lot of times I see traders will miss their entry and try to chase price. As they see price accelerating, for example, to the upside, they try to enter the trade and then price just drops and it just gets too messy. Now you're risking way too many handles. And if this trade doesn't work out, you've lost maybe 60 handles instead of 30. And it's just a messy situation. So don't ever chase price. Let price come back to you. And if it doesn't, so be it. Wait for the next opportunity to occur. Now, the third thing that we have here is don't hesitate. A lot of people, again, hesitate to execute on their trades that they've seen and backtested many times. And that, again, has a very, very bad impact on your trading. As soon as you see the model and your entry point form, execute the trade. Don't think about it. Don't think about price hitting your take profit or stop loss. Just execute. You've done your job and that is it. You've done your task, whereas execute at the right perfect time. No need to overthink about it and hesitate. The fourth thing that we have here is control what you can control, such as your position size, your stop loss placement, and your take profit point and time of entry. One thing that you can't control for sure is the market. We don't know where the market's going to go. No one knows where the market's going to go, whether it's going to go up, down, sideways, or even do circles. We don't know where the market's going to go, right? So the only thing that we could control is our position size, where our stop loss goes, and where our take profit goes. These are the things that we could control. If you control these and try to reduce your risk as much as possible, you should be absolutely fine. Now, number 5 on our checklist here is never re-enter a trade. If you take a trade and get stopped out, don't rush to re-enter the trade. You were stopped out for a reason. Price is moving in an opposite direction of your trade. Instead, step back, stay patient, and wait for the next opportunity to come. You got stopped out for a reason because price is willing to go in the opposite direction. So stop, step back, and do not re-enter a trade. Just wait for the next opportunity. Now, the last point on our psychology checklist here is detach yourself from money. Focus instead on your model, technical analysis, execution, proper take profit and stop loss levels, when to trail your stop, your timing, and all the elements of your trading approach, except the money. This mindset will make your trading much more easier. Let's say you execute a trade and you're up already $200, $500. Your psychology and emotion are always just going to get onto each other and you want to take that money, but you haven't hit your TP yet. And then your stop loss, what if it just drops down a little bit and then I'm going to stop that? Don't think about all of that. Just patience. Let price do its thing. Act like you're not even in the trade and see what you would do. when would you trail your stop loss? Where would you trail your stop loss to? Where would you take partials and where would you take your final profits? And let price play out. You need to detach yourself from money. Now getting into the source, the A plus entry model criteria. First thing I want to see is a sweep of liquidity. This is the things that I have to look for every single trading day and every single trading session. I have to see, first of all, a sweep of liquidity, whether that being London highs or London lows, Asia highs or lows, previous day highs or lows. Then I want to see a swing high or a swing low being created. And the reason why I want to see that is because without number 2, no number 3 and no number 4 could be possible. So number 3 on our list is going to be a market structure shift, breaking the latest swing high or swing low and closing above that latest swing high or swing low. And the fourth thing is a displacement in the opposing direction. This indicates that price is willing to go into that direction, whether it being bullish or bearish. After that, these two, the market structure shift and displacement, there should occur a fair value gap. And a fair value gap is essentially a 3 candle pattern where the first candle and the third candle do not overlap and there is an efficiency in between. As soon as we get that fair value gap, now I'm waiting for a retracement into that fair value gap to execute my trade. Number 7, entry must be inside of the first AM macro, which is from 9:45 to 10:15, or the second AM macro, which is from 10:45 to 11:15. And this is very, very crucial. Our entries must be only in those 2 30-minute time frames. Number 8 on our list is our stop loss. Where do we place our stop loss? We place our stop loss above a swing high or below a swing low. And if the number of handles exceed 30 handles in order to reach that latest swing high or latest swing low, then we place our stop loss above the displacement candles high or below the displacement candles low. Number 9, again, we're only max risking of 30 handles on NQ, no more than 30 handles. And number 10 on our checklist is we're targeting always opposing liquidity, such as London highs or lows, Asia highs or Asia lows, previous day highs or previous day lows, buy side or sell side liquidity, relative equal highs or relative equal lows, or even better, equal highs or equal lows, or the 50% range, which is called the equilibrium. All right, so here's an example of the ICT silver bullet model. So let's run down this model from A to Z, and I'll be showing you guys where I'm going to be entering, where my stop loss is going to be, and where I'm going to be taking profits, and so forth. So the first thing that we want to see on our checklist is a sweep of liquidity. And in this case, we get a sweep of liquidity of London highs. So buy side liquidity got swept at 10:07. Now, the second thing I'm looking for is a swing low to be created. And as we can see right here, a swing low was created at 10:25. And just for clarification, a swing low is, let's say this is candle 1, and this is candle 2, and this is candle 3. Candle 2's low is lowest of number 1 and 3. So this is a swing low. This is what it looks like. And so it's considered to be a swing low. So we do get a swing low at 10:25, but we do not get a break of market structure. We do not break market structure to the downside. Market structure hasn't shifted yet, and certainly we do not get a displacement to the downside. We do not close below this swing low. We close above it, as we can see right here. So that is obviously not valid. Another reason what makes this trade not valid is the time. It is 10:30. That is not in a macro. That's not in the first or the second AM macro. So we wait. Even if we do get a displacement to the downside here, we do not enter the trade because it is not in our macro times. Then we get another swing low here created at 10:30. We wait. Then we also get another swing low here created at 10:35. Then eventually we do get a break of market structure to the downside and a displacement creating that market structure shift. As we can see right here, price broke market structure to the downside and it closed way below this swing low. That is considered to be a displacement and a market structure shift to the downside. Now, with that comes a fair value gap. As we can see right here, a fair value gap was created at 10:40. And essentially what a fair value gap is, it's a 3 candle pattern. And in this case, it's a bearish fair value gap. So pretend this is going to be number 1 candle, number 2 candle, and number 3 candle. And the first candle's low and the third candle's high do not overlap. There's an inefficiency, and this is just considered to be a fair value gap. So we draw that out in time, and there we have our fair value gap. Then the thing that we're waiting for is our entry point. And our entry point is going to be a retracement into this fair value gap right here. As you can see, price does retrace into that fair value gap at 10:44. But we have a problem. The problem is it's not in our macro time, okay? So we do not take the trade, we wait. It's literally a minute away. I know it's annoying, but we have to wait. We have to follow our rules. That's what trading is all about. It's following your rules. So right here, we get a retracement into that fair value gap at 10:45. So as soon as price touches that, we execute the trade going short. Now, as soon as we execute the trade going short, now we need to place our stop loss. And our rule is we need to place our stop loss above the nearest swing high. In this scenario, it's going to be right here above the nearest swing high. and we're going to be covering 20 handles and 3/4, which is great because it is under 30 handles. Now for our target, we're going to be targeting the nearest swing low or the nearest sell side liquidity, because again, we're always going to be targeting opposing liquidity. In this case, it's going to be this swing low right here. We'll draw that out in time and price hits ever so perfectly. Now let's talk about trailing your stop loss. So the way I like to just trail my stop loss, and I think it's a great way to trail a stop loss, is wherever we have a swing low. So we're in a trade right now. We get this swing low prior to entering that trade, as we can see right here. But price breaks this swing low. So price shouldn't really come up and take this swing high. So what I want to do is, as soon as price breaks the swing low right here with the strong close below the swing low, I want to trail my stop loss all the way down to this swing high right here. Pretty much break even point. We're risking 2 handles. And again, as you can see, price comes back up and then breaks this swing low right there. Now, where's my stop loss going to be? It's going to be at break even above this swing high. Okay, so every time price breaks a swing low, I'm putting my stop loss above a swing high. I want to reduce the amount of risk, and eventually I want to be bagging something at the end of the day. So as you can see right here, price retraces back up, fills this 1 minute fair value gap, and then again respects it. It does not come out of this blue box, and respects it and drops down. In the meantime, we do get a swing low, price breaks it again. I'm moving my stop loss now to here. That's my stop loss. I'm moving my stop loss to this swing high. The worst case scenario, price retraces, I'm taking home 12.75 handles. Not bad. Price just drops and then hits our take profit right there. That swing low, and we secure 46.25 handles. Something that I do want to mention to you guys is, do not get greedy. You don't want to be targeting something like this right here, the maximum opposing liquidity, going for about literally 125 handles. You don't want to be doing that. Why? Price is not always going to go to your take profit, and that is extremely far away. That's why we're going to be always targeting low hanging fruit. And in this case, our low hanging fruit was this swing low right here. It was good risk to reward, and it made heaps of sense. Another thing you could be targeting, which is not considered to be greed, was the 50% of this price range. As you can see right here, our 50% is measured from the swing high to the swing low. The price kept on rallying up. We do get this 50% range. You could also be having partials that are running all the way to that 50% level, which could have bagged you another couple handles. But you should be out of the position totally here. And if you really want to leave one more partial running, you could target this unfilled 1 minute fair value gap right here underneath this 50% range, which is considered to be unfilled fair value gaps in a discount. So it could be targeting this area right here. And you can see price literally runs into it, respects its constant encouragement, and then reverses into the upside. So it's very important to take low hanging fruits. And if you do want to leave a runner or two, make sure to have obviously your stop loss at least to break even. So just so you can secure profits, or even to try your stops to your nearest swing high every time you take a swing low in this scenario, in this bearish scenario. And something that I also want to tell you guys is, do not trail your stop loss very aggressively. You don't want to just be trailing your stop loss just because price pushed down without breaking a swing low. You want to have your stop loss always placed strategically before you get stopped out prematurely. Okay, you don't want to be stopped out prematurely and see price running to your take profit. All right, so there you have it, the ICT silver bullet model in practice right in front of you guys. If you guys did really enjoy this video, please leave a like, comment, subscribe down below. If you guys got any questions, be sure to ask them down in the comments below, and I'll be sure to answer them and get back to you guys as soon as I can. Just a reminder, the top trading floor and the VIP top trading floor servers, their links are both in the description down below. Be sure to check them out, and I'll see you guys in the next one. Peace.